Welcome to 2018 and 2019 Tax Update and Tax Tip webinar, which is updated for the new tax law. Before I get started, let me introduce myself. My name is Shams Khan. I'm a CPA, CFP, helping my clients for almost 20 years across the country in different industries. And in today's webinar, I would like to share some of the tax strategies and tax tips that some of our clients have used over the years. All the slides for today's presentation you can find on our webpage at skfinancial.com. Scroll down on the home page and you will find it under free ebooks at the left corner at the bottom. The law that we will mostly be talking about was passed in December 2017 and it is effective for year 2018, and most of the provisions will expire in 2025, so just keep that in mind. There are two parts to this webinar. The first part is we will talk about its effects on individuals, and in the second part we will talk about its effects on businesses. Under the individual, we will talk about the new tax rates, the standard deductions, itemized deductions, what was repealed and what is still there, and numerous other issues. First, let's talk about the tax rates. The tax rates for married filing jointly, we can find it here. The second column shows the rates, what it would have been based on the old law. And the last column shows the new tax rates based on the new law. So as we can see, most of the rates have gone down from 15 to 12, 25 to 22 and so forth. And the top tax bracket, as we can see, has gone down from 39.6% to 37%. And the threshold amount has also decreased from 480 to 600. So the top tax bracket of 37% only be applicable if your income is above 600,000. Similarly, for single, you can see all these rates. The top tax bracket is at 37% now, which is applicable above $500,000. And again, you can see these rates for head of household. A lot of these slides that you will see here, most of the information can be used as a reference guide. You can go back and use it for that purposes. I might not cover everything on the slide, but it can be used as a reference. Head of household, again, the top tax bracket is at 37%. For estate and trusts, we can see the top tax bracket is at 37%, but it's been hit with that rate at relatively low income of 12,500. So as we can compare this with individual rates, it get hit with the top rate at 12%. So it will be in our interest not to have that much income in any trusts or estates. Kiddie tax is a tax on children's unearned income, which includes interest, dividends, capital gains, and so forth. Before, the first $2,100 were taxed at child's rate, and anything above that were taxed at parents' rate. But now children have their own tax rates, and they can no longer report it at the parents' rate, and they will have to use these rates. And anything above 12,500, they will be taxed at the top tax bracket of 37%. Plus, on top of that, they will also be charged a 3.8% of net investment income tax as well. So as we can see, it's no longer that advantageous for children to have these investment or brokerage accounts. We have a lot of clients that have kids with these accounts, so this would be time to revisit those accounts, and especially if they are generating income or in a top tax bracket or so forth, then you might want to change those accounts. For capital gains tax, there are no changes. The tax rates are the same. The threshold amounts are the same. Just keep in mind that the rate is 0% for long-term capital gains for income below 77,000 for married filing jointly, and then it goes up to 15%, and then you get hit with the top tax bracket of 20% for income above 479,000 for married filing jointly. For capital losses, you can only deduct up to $3,000 in any given year, and the rest is carried forward into future years till you use it up. There is something brand new in year 2018 that is called New Opportunity Zone program. If you are expecting high capital gains, then one way to defer that any tax on that would be to invest in this program. And if you invest the proceeds in it, then you will not be taxed till you take it out from that program. So that's something to look into, especially if you're expecting higher capital gains. And again, as I mentioned earlier, there is this 0% tax rate for anybody in the with income of less than 77,000. So if you have an adult child or a parent that is in that tax bracket and you're expecting a capital gain, so you can potentially give them depreciated stock and then they can sell it and not pay any taxes. The other side would have been if you would have sold it, you would have paid tax on it, but if they sell it, they would not pay tax on it. So that's one strategy to keep in mind. There is no change to the Medicare 3.8% tax on investment income, which includes interest, dividends, capital gains, rents, and so forth. It is applicable if you're single with AGI of more than 200,000 or married filing jointly with income of more than $250,000. So one way to lessen that tax would be to invest in municipal bonds, or the other way would be to use an installment sale on whatever is generating or triggering this capital gains. So if you're selling capital assets, so you can plan it or structure the sale as an installment sale so that you can get the proceeds over a number of years. And a lot of our clients have used this strategy and they don't get taxed at a higher tax rate in one given year, but they stagger it over a number of years. Let's move on to standard deductions and personal exemptions. There are huge changes here. As we can see, for married filing jointly, the rate has gone up from $13,000 to $24,000, almost double. Similarly, for singles, it's now at $12,000. On the flip side of it, personal exemptions are gone. Personal exemptions, we were entitled to it. For every dependent on our tax return, we were entitled to $4,150 as a deduction, but going forward, we would not be because of the higher standard deduction. So just because of this fact, more and more people would take standard deductions rather than itemizing on their personal tax return. Since they got rid of the exemption amount, they enhanced the child tax credit. Now they have increased the threshold amount. So for married filing jointly, you can still get the deduction, child tax credit deduction, up to income of $400,000. Before, it was at $110,000. So income above that, you are not entitled to it, but now you can still get the child tax credit up to income of $400,000 for joint, and for others it's $200,000. And not only that, they also doubled the credit amount from $1,000 to $2,000. So for a family of 2 kids, you can get a $4,000 a deduction, a credit, dollar for dollar, reducing your tax liability if your income is below these threshold amounts. And they also come up with a new tax credit for non-children, which would be other dependents like parents and other relatives that you claim on your return. So instead of claiming an exemption for that, you would now be entitled to a $500 credit for them. So a new credit, a good deal. Moving on to alternative minimum tax, unfortunately, they did not eliminate this for individuals. Unlike businesses, for businesses it was eliminated, but not for individuals. But the threshold amounts have been increased, so less and less people would be subject to it. So that's all you need to know about alternative minimum tax, that the threshold amount has increased, the exemption have increased, and it's less and less people would be subject to it. Earned income tax credit, there is no change there, but it's good to know the threshold amounts, especially if you are claiming it or if you know somebody that is utilizing this credit. For example, with 2 kids married filing jointly, the maximum tax credit that you can get is $5,728, and that phases out at 24,000, and then it's totally gone when the income is above $51,000. In this particular case, a lot of people try to put as many deductions on their tax return as they can to reduce their income, but it's not always beneficial. As we can see here, as the income goes down below then the threshold amount, then you start losing the credit. So sometimes it's beneficial not to have all those deductions on your personal tax return that are not applicable to the return. Moving on to Social Security, no changes there as well, but we need to be aware of the new threshold amounts for year 2019. It will be subject on the first 132,000. The rate has still stayed the same at 6.2% Social Security, and Medicare is at 1.45%. And on top of that, if you are making more than 200,000 for singles or 250 for couples, you will be subject to 0.9% Medicare tax as well on your W-2. And if you're a self-employed person, the 6.2 and 1.4% is doubled. So you are paying the employer and the employee portion as well. The nanny tax, you will be subject to Social Security as well. Social Security, on the recipient side of it, the benefits gonna go up by 2.8% for 2019. There are some limitations on income when you are going to be taking the benefits. So keep in mind those threshold amounts. If you are above 66, then there is no income limitation. You can make $1 million and still get the maximum benefits from Social Security. But in the year of retirement, you can only make up to 46,000 till the date you reach the 66. And the year between 62 and 65, your income can only be less than 17,000 till you start losing the benefits. So keep these in mind. If you have any questions, and if you are our clients, call us and we'll discuss that. If not, you can go on Social Security website and research this. And for that matter, while we are going through this webinar, if you are our client and you have any questions, just jot down all your questions, and next time when you come to our office, we'll discuss all those, or you can email it or call us and we will answer or elaborate on any explanations you might need. So you can go through and write down all your questions and concerns. And in order to qualify for Social Security in any given quarter, you need $1,300 for the year. It's roughly $6,000 to get the credits for that year. This slide shows the Medicare Part B and Part D premiums for year 2019, and as you can see, as the income goes up, the premium amounts goes up as well. This is an informational slide as well. Moving on to estate tax, huge changes there as well. They almost doubled the exclusion amount from 5.6 million to 11.2 million dollars. Between husband and wife, it's 2.4 million dollars if you utilize the portability clause on the death of the first spouse. So as we can see, it's a fairly higher amount, and less people would need an estate plan under these threshold amounts. But if you think your estate is going to be higher than this amount, then do consult an estate attorney and devise an estate plan. And if you are going to be above this threshold, then you can potentially gift $15,000 tax-free to any individual, and between husband and wife, it could be $30,000 to an individual person. And with the new tax law, they also kept the step up in basis, meaning at the date of death, the basis of the property is changed or stepped up to the fair market value on the date of death, so which is a good deal. And if you think your estate is going to be higher than exclusion, you can give the gift of 15,000, or you can give them fractional share in a LLC and so forth to your kids as well. Okay, let's talk about itemized deductions or Schedule A. Before, people would take all these deductions on Schedule A, and if your income was high, there was a limitation. It would decrease your overall deductions, and you would think you are taking everything, but in reality there would be that deduction limitation, which was called Pease limitation. The new tax law got rid of that, so it's no longer applicable. On medical expenses, at least for year 2018, you can deduct any medical expenses above 7.8% of AGI. So if you have 100,000 AGI, and of course you have to consider the standard deductions amount as well, but anything above 7.5% of that would be considered a medical expense. And after 2018, it will jump to 10%. So as you can see, with the higher threshold amounts, less and less people would be able to deduct medical expenses. So the way around it is to incur these medical expenses through an HSA account if you are an individual, or if you have a business, then you can set up an HRA account, health reimbursement account, or there is something new called qualified small business QSE HRA accounts that you can set up through the business for your employees, and they can pay for these expenses and have it as a deduction. So if you have further questions, you can contact us, or you can Google these things. And another big limitation is on real estate taxes. In the state of Florida, we don't have any income tax. So if your real estate taxes for the year is $12,000, you would be able to deduct first $10,000. In other states, say if you have paid $20,000 in income tax and $10,000 in sales real estate taxes, combined is $30,000, but you would only be able to deduct $10,000. So it's huge. It's going to affect a lot of individuals. Mortgage interest, again, there are some changes. The total amount of the loan has changed from million to $750,000 acquisition debt. So this is for any loans that you got in year 2018 and going forward. You can still deduct up to $1 million of debt for previous loans. And Another thing that they did was they totally eliminated any deduction on home equity interest unless the proceeds are used to buy the house or any improvements. So if it's used for any other purpose, you bought got a line of credit and used it to buy a car or any other assets, it would not be deductible. The tracing of the home equity debt remained the same, meaning if you get a line of equity, and a lot of our clients do that, they get a line of credit on their primary home and use the proceeds in their business. You can still do that and take a deduction on your business as long as once you get the line of equity, directly transfer the money into the business bank account and let the business use it. That way you can deduct the interest. So that it's called tracing rule. You can do that, but be careful not using it for personal needs. The tax tip that goes along with the mortgage interest is, since not that many people gonna be itemizing and the threshold amounts have gone up, so it makes sense to pay off your primary home if you have additional cash rather than paying off any business loans, because business loans you can still deduct. Primary home, especially if the debt is more than 750,000, it makes sense to pay that off. For charitable contributions, you can now contribute up to 60% of your AGI instead of 50%. Of course, you would want to contribute appreciated assets as opposed to the assets that have gone down in value. Be careful with making contributions to conservation easement programs. They are highly litigated and high in risk, audit risk. Some of our clients have invested in those. And on top of that, there is a disclosure requirement. So whenever you make any contributions to those programs, you have to disclose it now on your tax return. And also be aware of the requirements for private foundations. A lot of rules and regulations that you need to worry about. There is something that you can do instead of private foundation, and that is a donor advisor fund. We will talk about that in a minute. You can also contribute up to $100,000 if you are above 70 and a half in age, directly from your retirement account to a charitable organization. So they kept that, so which is a good deal. One strategy is bunching, where you bunch all your itemized deductions in 1 year and take a standard deduction in next year. So if you spread it out over the years, then your deductions is always less than standard deduction, and you never itemize. Under this strategy, you itemize 1 year, take a standard deduction next year. And this strategy is more applicable now that the standard deduction amount is higher. You can defer some of the discretionary medical expenses to the next year, or charitable donations. You can incur those in 1 year and take a deduction and so forth. Sometimes it's difficult because you want to make those contributions, charitable donations, each and every year, rather than doing it 1 year and not doing it in the next year. So in that case, what you can do is you can establish a donor advisor fund. Fidelity does it, Vanguard does it, so many other providers do it. You just open an account and fund it. You can fund it with cash, securities, bitcoins, real estate, and whatnot. And the day you fund it is the year that you're gonna be taking the deduction on your tax return. And then you would advise the donor advisor fund to make the contributions to whatever charity you want in whatever year you want. So you take the deduction in the year you write the check, and then you fund the charities in the year you wanted. So that's a good strategy. And of course, the contribution will be made to 501c3 organizations. And another benefit of the donor advisor fund is you will just need to worry about one receipt, only one check that you have written to the advisor fund. That's the only receipt you need. And then the advisor fund itself would keep track of all the checks that they write to numerous non-for-profits. Personal casualty and theft losses are also suspended unless it is for federally declared disaster areas. All the hurricanes hit areas would be considered federally declared disaster areas, and we can deduct those subject to these requirements for those areas. Another big suspension of an expense is unreimbursed employee business expense. A lot of our clients over the years have taken these deductions when they have a W-2 and they incur different expenses. It could be for travel, auto expense, home office expense, supplies, uniforms, and job search expenses and so forth. None of those expenses going to be deductible anymore. The only way to deduct some of these would be if your employer reimburses you through a reimbursement plan, and this is what we talked about earlier, for employer to set up for the employees so that they can reimburse for their expenses tax-free. Another item that is suspended is investment expense, which includes all the fees that we paid for money management, for IRA custodial fees, investment fees. So all of that stuff is no longer deductible. And finally, tax preparation fee and safe deposit fees are also going to be not deductible anymore. As far as tax preparation fees are concerned, we can allocate a portion of it to other schedules, to Schedule C, E, and F, which are business related schedules, and take a deduction that way. But no longer it's going to be deductible on Schedule A. Debt forgiveness on your primary home is no longer a tax-free event. You unfortunately have to pay tax on it unless you prove yourself to be insolvent taxpayer, and that's true for any other loans as well. And you can only be insolvent if your total liability or your total debts are more than your total assets. That's the only way to claim that exclusion and not pay tax on the debt forgiveness income. Gambling losses, everything is the same. The only difference is for the losses they have included travel and lodging. And again, the gambling losses we can only take up to gambling winning, up to that extent. So far we talked about the deductions that were suspended on Schedule A. Now we'll talk about items that affect the adjusted gross income. The first one is alimony. That's been suspended. That's huge. We have a lot of clients that have taken this deduction, and it was a taxable income for the recipient. Going forward, starting from 2019, it's not going to be the case. It's going to be like child support, which is not going to be a taxable event on either side. And just keep in mind that this is one of the only items that is applicable to 2019, not 18. And another item is the moving expense that has also been suspended, so you can no longer take moving expenses on your personal tax return. And if you're reimbursed by your employer for moving expenses, it will not be tax-free income, but it will be a taxable income to you. The biggest change under retirement accounts is the repeal of Roth IRA recategorization. Before, when you did the conversion from a traditional IRA into a Roth IRA, you could undo it and go back during certain period of time and undo that conversion. Going forward, you cannot undo that. Once the decision is made and you do it, you cannot undo it. So just be careful before making that decision. Here it is an informational sheet that lists the contributions limits for 17 and 18. For 18, we can contribute 5,500 to any kinds of IRAs, including Roth IRA. And if you are over 50, we can do an additional 1,000. So that will make it 6,500 contribution. For SEP, we can do 55,000. For simple, we can do 12,500. For 401ks, employee deferral is 18,500. And if you are above 50, we can do an additional 6,000. And total employee and the profit sharing combined for a retirement account is 55,000. And finally, for defined benefit plan, we can do $220,000. Just keep in mind that if you want to make any contributions and you don't have these retirement accounts, you have to do it. You have to set it up before the end of the year. And if you want to make the contribution for a 401k, the only ones that you don't need to do it until the end of the year are SEP IRAs or regular IRAs. Exemptions to the 10% penalty for early withdrawals from your retirement accounts. You will be subject to it if you take out money from retirement account before 59 and a half, unless you fall under one of these requirements. And IRS have an extensive list. I have listed this URL so you can go there and see if any of those exemptions apply to you. It's mostly for medical expenses or for a down payment for your primary first home, or if you annuitize these payments, meaning if you take out portion of the payments and spread it over a number of years. So these are some exemptions that you can take. On the insurance side, the individual mandate is going away for year 2019. For 18, if you don't have health insurance, you will still be penalized and you will be required to pay penalty. So this is only applicable for 19. And the 3.8% net investment tax and the 0.9% Medicare tax, as we talked before, are still part of the Obamacare, and it's still gonna stay. And again, to mitigate those taxes, you can invest in municipal bonds, or utilize in installment sale, or like-kind exchange for real estate. The subsidy itself, if you are getting a subsidy through the exchange for your health insurance, make sure you notify the exchange if there is a change in the family size, household income, or you're starting a new job. And the subsidy itself, you are entitled to it if your income is between 12 to 48,000 for singles, or 24 to 98,000 for families. So those are the thresholds. It's good to be aware of those. If you fall in those, then it makes sense to get insurance through the exchange so that at least you benefit from the subsidy. Hobby losses. Before, you were able to deduct the hobby losses against your hobby income. Going forward, starting from 2018, you cannot deduct any losses, hobby losses. You can only report the income with no hobby losses. So that's a big change. The way around it would be, of course, to make the business profitable so that you can show it as, instead of hobby, show it as a for-profit business. And of course, you can consider incorporating the business as well. The last item is an informational sheet for travel. And if you are claiming the per diem rate for travel, you can go to this URL, IRS, the government website, or if you are using high and low method, then these are the rates. Every October 1st, IRS releases these rates. So for the first 9 months, you have one rate, and then the last 3 months, you have a different rate. So that concludes our individual update portion of the webinar. In the second part, we will talk about business update and the tax tips that goes along with that. So make sure to attend that. If you have any rental properties, any businesses, Schedule Cs, K1s, any of that things, then the business part would be applicable to you, because even if it's a business update, eventually everything flows through to your personal return, and some planning is required on those lines as well. So thank you.